Bill, it sounds like at this point you're saying a recession is likely on the way. Is there anything this country could do at this point to avoid a recession? And are you seeing it coming just for the United States or also for the Eurozone?
No, I think for the Eurozone as well, Poppy. I mean, basically policymakers have limited options from this point forward. In terms of the central banks, the Fed and the ECB, they've reduced interest rates down to near zero, and many of them are conflicted. You know, the Fed, for instance, has a bullish portion and a bearish portion. In the ECB, they're conflicted as well in terms of writing checks for Greece and Portugal and Ireland. In the United States, in terms of fiscal policy, conflict as well, as we know, with the debt ceiling, with the Gang of 12, with the ability of Obama to generate anything in terms of producing jobs from this point forward. So what we're seeing in the developed world is a world in which growth is limited because of too much debt and because of the lack of policy options going forward.
Well, New York Fed President Bill Dudley recently still maintains that he believes that the risks of a recession in the United States are pretty low. He's been one of the big advocates of QE3. You smile. I'd like your reaction to that. And just what ammunition you think policymakers in this country have to fight off another recession, even if it may be more mild than 2008, 2009. What do they have in their war chest?
Well, up until this point, the quantitative easing programs, the QE1s and 2s, have depended on lowering interest rates and producing a bid for risk assets. To the extent that interest rates are down to 0% for 2 and close to 5-year treasuries, there's limited space going forward in terms of any policy that might even be announced at Jackson Hole next week by Ben Bernanke. In terms of fiscal policy, the momentum basically is for contraction and for what economists call fiscal drag, in which money is taken out of the economy based upon conservative types of spending philosophies. And so in combination, we have what we call a stall speed economy, in which there's an inability to provide policy momentum from either the Fed or from Congress, and therefore if it doesn't go up, then it comes down. And we're seeing that with today's economic numbers, and I think we'll see that over the next few months in terms of employment growth and actual GDP growth.
What does the global economy need to hear and, more importantly, see from the ECB and from the Fed?
Well, from the ECB and from fiscal policy in terms of core Euroland, they need to see the willingness to write checks. Basically, the ECB has been doing that to a limited extent. Angela Merkel and Mr. Sarkozy came together earlier in the week and basically said that they were united between them, but united in the effort to basically move towards a balanced budget, even a balanced budget amendment. So what I think we need from them and what I think we need from the ECB is a willingness to sort of back off and to recognize that balanced budget should come later as opposed to now. What we need in the United States is a similar type of effort to recognize that stimulative policies and investment and otherwise from Washington basically should be front-end loaded as opposed to back-end loaded, and that the budget balancing should wait for the out years.
Finally, is this run into gold and into U.S. Treasuries despite record low yields, is that wise right now for investors?
I don't think so. I think investors should recognize that there's limited room for price appreciation, and of course the yields themselves are 0.5% to 1% and maybe 2% for a 10-year Treasury. What I would do as an investor basically is depend upon a consistent stream of income going forward from high dividend stocks. I'm talking about a Verizon. I'm talking about a Southern Company in terms of an electric utility. I'm talking about 4.5% to 5% yields that basically are consistent even in a slowdown or a recession going forward.